Hey everybody, it's about 1:30, so we're going to get started. I'm Lyn Adams. I'm one of the founders here at Adams Financial. I also have on the panel with us Justin Gross. I'm not sure if you can see his screen. I think you can. I'm going to switch over and share this PowerPoint. We're going to go through today's content. While we're getting started, I know that with Zoom, we're always learning a little bit more about how it all flows and works. If you have a question, you can use the chat box or the Q&A. We're going to have Nat making sure that we don't miss any questions. And I'm going to try to pay attention to that screen as well as we go. So as we get started, just wanted to, again, welcome you to our call today. Briefly, everything we talk about today is for educational purposes only. Nothing that we say in this session is intended to be specific investment advice. And we're going to meander into a topic that I don't like to talk about, politics a little bit as we go through it, but I think it's important for everybody to have a good understanding of some of the things that our potential leaders have put into their agendas and how it might impact the market and even our individual financial plans. So with that, we'll get started. Here we go. So just a real quick look here year to date at returns through the end of the quarter. Obviously, you've had a pretty difficult year in a lot of different investment categories. The only sector that's clearly positive is the U.S. bond index, basically the flight to safety trade. So it's up 6.8%, and that's, of course, on the heels of interest rates falling pretty dramatically to near zero levels in a lot of different spaces in the bond world. The S&P index is technically up 5.6%, but as we'll show you here shortly, that may not be an accurate reflection of where the economy is at here in the U.S. Emerging markets are slightly negative. The developed international markets are more substantially negative. Russell 2000, which is the smaller 2,000 companies in the U.S. that are in index representing small cap stocks. The commodities have been beaten down pretty bad. So have the metals in a lot of cases, and then REITs. Real estate investment trusts are also down double digits. So definitely not a good year. Our strategies in terms of our managed account portfolios year to date are anywhere from +1 to -2, depending on levels of risk. We're obviously diversified in our strategies. We don't just have one piece. So you got to take the goods that come from the bond market there, and you also got to weigh in the cost of being diversified into different things that have had to go through this market adjustment. 500 largest companies in America indexed together. When we talk about valuation, what we're really saying is how expensive is this market relative to the earnings that it produces, and also relative to maybe the yield that it has, or relative to the cash flow that these companies produce. The chart shows us here that as of the end of the quarter, the S&P 500 as a whole was selling at 21.54 times annual earnings. That, by historical standards, is expensive. The average price to earnings ratio last 25 years is around 16 times earnings. And anytime you get more than one standard deviation away from the mean or the average, you know that there's a lot of drag to pull that level back towards the average. The further away you get from the middle, the more you would expect it to have a greater pull to get back towards average. So we do think things are a little bit pricey in terms of valuations for the S&P 500. Here's something that I'm not sure everybody fully understands, though, about the S&P 500. The 5 largest companies in the S&P 500 year to date through the end of the quarter were up 37% year to date. The other 495 companies have averaged -4 year to date. So there's a divergence between the return of 5 mega cap companies and most of the actual S&P itself. And of course, there's interesting correlation that the smaller the companies are in the S&P 500, the worse their actual year-to-date returns categorically have been. So we've seen a few times in the past where this concentration of investor capital lands at just a top, very few number of companies at the top of the food chain in terms of size. The last time we saw convergence like that was really 1999 and early 2000. And, similarly, a lot of tech companies were the few winners going into the beginning of that recession that was in that period of time.
Yeah, so just a quick comment on that. Can you hear me?
Justin, I don't think your mic is on. Maybe my speaker's not on. Hang on one sec.
Can you hear me?
Can you hear me, Justin?
Yes, I've got you. Can you hear me?
I can't hear you. Let me check. Try that again.
So Kevin says he can hear both of us.
Okay, you're good. Okay, great.
So quick point there on what we call concentration risk. I mean, you've got around 1% of the companies in the S&P 500 driving most, if not all, of the positive returns. Okay, so it's fairly concentrated, even by historical standards. Most of those companies, as Lyn mentioned, are technology companies, which by nature are a little bit more volatile, more high beta. That feels really good when they're going up, not as good when they're going down. So for more conservative portfolios, you may not have a lot of exposure to those type names. And if you look at a more conservative index like the Dow, that index was down about 2.65% at the end of the quarter. So it's a double-edged sword. You like to get some exposure to those names, but they are a little bit at stretched valuations, some might say, especially if you look at reversion to the mean like we did with the multiple on the S&P. And that feels really good on the upside, but doesn't feel so good on the downside. So we have to continue to monitor that.
Yeah, I actually have heard several analysts talk recently about if you are buying those top 5 brands today and you're putting new money in there, what you're really betting on is that the rest of the investment choices are going to stay in a uninvestable category, meaning that we don't think things are going to get better for the other 490 some companies, or the mid caps or the small caps. Like if you were really going as an investor and said, I'm going to put my money in those top 5 mega caps at this moment, it's because you would have to have a view that things are going to stay in a similar state where a lot of these places are closed down and people aren't able to get back to full employment, and that COVID will be here for the long run. And those things may be the case, but if you didn't believe that, you would have to take the mindset as an investor that these other companies are selling at a significant discount to these very expensive top 5 or 6 are probably a better investment value than ones that you're paying, extremely high valuations. Now, obviously, we don't have a crystal ball. We don't know the answer to that question, but it does put people in a very strange moment, because a lot of people, like in the retail investment community, tends to chase returns. So they'll look at what just went up and say, that's what I want to buy, but it's already gone up.
Well, we can end this part with this, but it's also not a this or that. Especially with some of the strategies we use, if you classify as trend following, that trend is firmly intact. So we can continue to experience gains and get some gains in portfolios from those sectors and those names, but be ready to have a change of strategy when that time is right, because we're observing some concentration risk.
That's right. Okay, so again, this next section here, we kind of call it Reshaping America. This is really just trying to kind of account for the fact that COVID and the China trade war together is kind of like the 1-2 punch that has really wiped out a lot of the gains that we've seen. A lot of people would say you see these kinds of gains once in a generation, and it's been a pretty steadily falling unemployment since 2009. All the way to the lowest unemployment we've had in 50 years, and suddenly between the China trade war and COVID-19, we blew unemployment up, to historical numbers briefly. We've had huge gains in manufacturing and industrial production. And again, those really took a huge hit this year with COVID and the China situation. Real estate has actually bounced quite nicely here in the last month or two. So out of these four sort of frequently observed sort of market indicators, real estate has actually done well. But a lot of that is, has to do with the population of the millennials, needing to get out of their tiny house and get into a place where they can have kids and start a family. And at the same time, mortgage rates are, as low as any of us have ever seen in our lifetime. So that makes sense that real estate would have a nice bounce. And then just a lot of the day-to-day materials, the use for lumber, steel, coal, all those things have really come down a substantial amount with COVID, and they are working their way back up. But a lot of the tailwinds from economic gains from the last 10 or 15 years have really been squashed in this sequence of events with COVID and China. All right, moving on. So when you talk about recession, we are officially in a recession. Anytime you get more than 10% decline in real GDP, that's the definition of a recession. I think it's always nice to kind of put it in perspective that, okay, well, this isn't the first time that we've been in a recession, and it won't be the last, but it is pretty big for the amount of time that it has taken to get here. Meaning, it's been less than a year in GDP decline as calculated through this particular study. June was already down 10%. That number might even become a larger number as we factor a full year of declines into the picture. But there's been other recessions. Now, ones that are this size, World War II was down 12% in GDP in the period of time. Of course, the Great Depression was down 26%. So by no means is this a little one. This is very substantial. And so one might ask, well, how is it that we're having this pretty substantial recession, and yet the stock market is, 1% or 2% away from an all-time high? And, of course, we just talked about that the stock market being close to an all-time high is a little deceiving, because there's really, 10 or so companies, 5 in particular, that have gotten a large amount of the inbound money. But there's a very narrow market that's just gone up so much that it's holding up the entire country in terms of valuations and stocks. But here's what people don't understand, and this is going to lead us into a little bit of the political discussion, is the amount of dollars that it has cost us and the rest of the world to fight the economic implications of COVID-19 is really historical. This chart here shows us that, okay, the Eurozone spent 5% more than their GDP. The far left blue dot, 5% more than their GDP. They printed money and put it into circulation, and it caused their debt percentage as a nation to go up. The green dots are historical scenarios. In the Great Depression, the U.S. went into debt. Government spending went up about 7% over its prior, and increased their accumulated deficit by 10%. World War II was very, very high level of spending. But this particular moment, when we look at the U.S.'s response to global coronavirus pandemic, we've produced about 15% of what our whole entire GDP produces in a year. We've basically digitally created that money, and we've borrowed it to put into all the different stimulus packages, which has now brought our level of accumulated debt to about 14% more than it was before the coronavirus issue started. And we were already creeping up to some pretty high numbers. And of course, Japan and other places in Europe have done even more. But when you think about the response globally, that nations have borrowed money to keep their workers with jobs and their citizens with the ability to pay their bills and food on their table, is pretty substantial amount of deficit spending going on around the world. The U.S. is a little bit higher than some of the smaller countries, but certainly not as bad as some others like Japan, Italy, or Germany. So we've borrowed a whole lot of money. And I think as we go into this election, one of the things that is unusual, at least from an observer of how these things work, is that normally in the past, I think the Republican Party tends to be a hot button is fiscal responsibility. Let's not spend more than we bring in. And the Democratic Party is more like, well, let's spend and take care of a lot of different spending initiatives. At this moment, because Trump is really a champion for big spending, neither party has a real tendency to say, we really got to do something about this debt. And so for the foreseeable future, I think we as Americans, we have to think of the future as being where we're gonna see the accumulated debt of our government be higher than it was maybe even in World War II, and we may not see it ever come down. It may be that way for a long time. And the chart here, these two charts are kind of connected, but one of the things that is embedded in this accumulated debt really going up by 2050 is the notion that interest rates would have to rise. And if you see at the bottom, the principal owed is the purple. It's the accumulated interest and the compounding of that interest that becomes really problematic. Well, today with interest rates near zero, it doesn't necessarily paint a terrible outcome. It's if interest rates go up by any significant margin, we would see this expand and make this debt become a harder to service issue. And I think the political component of this is that the leaders in Capitol Hill, they just don't have none of them have a really popular outcome if they say, hey, we need to decrease our spending and increase our taxes revenue. And that's just not popular stuff. So this data here that we're going to go through for the rest of this little section is actually a lot of it's been compiled through JP Morgan. And they put together a really great piece to say, what would it take for us to get the debt and any potential consequences that come from having this extreme amount of debt to make that problem get reduced. In other words, get back to where we were before the pandemic. And they've outlined 4 policies that need to happen, or 4 outcomes that need to happen that would get us back to where we were pre-COVID in terms of the overall debt of the country. And I think that regardless of who was elected, not only in the presidential situation, but also in the congressional areas, the direction of these 4 things are ultimately going to have to happen, or there'll be consequences. And we'll talk about maybe what some of those consequences might be, but these things are what needs to happen if you wanted to get this back on a track that was pre-COVID by 2030. So one would be, we would have to raise taxes substantially. So this is the projections of the current taxation. The blue is where we're at in terms of how much of a percentage of GDP that the government brings in taxes each year. And the red line is sort of the projections that the government budgeting office has put out based on what's been proposed and what's in the current laws. But this would need to move in a much higher direction and stay there for quite some time. They got to bring in more money. So that's kind of an obvious. The second is big spending cuts. We've been seeing government spending as a percentage of GDP tracking in the 20% range. It would need to get down to about 15% and stay there which is basically cutting about 25% of everything the government spends money on today. That would need to happen and stay there for an extended period of time to get that. Would be another contributing component to getting the debt to go down to pre-COVID levels. The third is a difficult one, but I personally believe it's not impossible because our demographics are kind of support that it could happen, is we got to recreate a growth boom, much like what happened in the late 60s. And, growth booms are created by having this sort of perfect formula of low interest rates, low unemployment, high population growth, high consumption, geopolitical happiness. It's like a little beautiful balanced thing that has to happen. And it only happens every now and then where you get all those stars line up the right way, and you can have a true growth boom. The roaring 20s aren't on this chart, but that was an incredible period of growth. So much so that when it corrected, it created the Great Depression, but the early 60s also had an incredible time of growth where GDP is up 4, 5, 6% a year for maybe even a decade. We're going to need that in order to grow out of this hole with tax revenues. And I think with the number of millennials that are getting higher paid jobs, are spending more, starting to increase their standard of living, it is possible that we would get a growth boom like that. But the steps that the politicians make to create the landscape for that, there's a whole lot of potholes that they could easily step in and get that off track. But that would have to happen in addition to higher taxes and lower government spending. And then the last piece, which is actually kind of more a newer theme that we're seeing from the discussions from the Federal Reserve, is that they've got to let inflation rise. For years, probably most of the last 2 decades, inflation has been a target at 2% or near there. And they just recently have kind of said, we got to let inflation get back up to 3, 4, 5%. And it's important for that to happen for us to get out of this debt. And he said, well, why is that? But it has to do with the fact that we have X amount of dollars of debt in today's dollars. And if, let's just say that for purposes of illustration, let's say our debt was, $10 trillion. And in order to pay that debt off, when we've got an economy that's producing $10 trillion, which these are just fictitious numbers because our economy produces a lot more than that, our debt's a lot more than that. But just to make sense of it, if you could inflate values of assets and tax bases and wages, if it all could get inflated quickly to where now in an economy, say 10 years from now, we're producing 50 trillion and it still costs 50 trillion to buy the same amount of goods and services that a $10 trillion economy could have bought 10 years ago. If interest rates don't rise very quickly, but we inflate the economy, then you're paying old money debt with new money that's worth less, and it just works in the favor of getting it paid off quicker. So the discussion that's happening at the Fed a lot is we need low interest rates and gradually higher inflation. But we haven't tinkered with intentionally higher inflation in over 20 some years. And that's the part that I think we have an opportunity as, investment advisors and economists and, stewards of the resources that you've entrusted us to manage, to recognize that, okay, we got to own things that can benefit with inflation, because this is going to be something that's a critical part of solving this problem in the future. So
I would interject here as we start. We understand, and everybody sees it, that political emotions are running really high right now. Some might even say this is dangerous to even speak on. This data is not from CNN, it's not from Fox, it's from JP Morgan. But whoever is elected is going to have to deal with some of the things we just talked about. So we just wanted to bring this data to you because we found it insightful, and so it's straight from JP Morgan and not slanted in any way.
Yeah, and please don't, I don't think we have a public opinion about, which is better. We're just trying to report the data in a way that it is relevant to the decisions that we make and you make as clients with your personal financial resources. And, there's a lot of people that would make the wrong choice of what assets to own if they thought inflation was going to be going down versus up, or if they thought taxes were going down versus up. So this is really just to help give you a really good, clear backdrop of where we're at and what's being proposed. So this next slide, again, this is all subject to change. This is really good research here. So Biden has put out his agenda on taxation and spending. And so you can get into all the line by line items, but the things on the left are the things that would increase tax revenue to the government if his agenda was made into law, which may or may not happen even if he does get elected, right? Because you got Congress and all the pieces there. So he would raise the taxes, tax people that make over 400,000 is the number, married, filing joint. There would be some industry specific taxes. Much of the corporate tax rate decline that Trump installed, Biden is saying, hey, corporations used to pay 39%. Now Trump's got them at 20. His target number is 28. So maybe about halfway back to where we were, an increase in payroll taxes. So those are the things that would create more money for the government. And he does have some agenda items to put back some of the tax deductible items that go with caregivers and home buyers, right? Now, he very different than what Trump has presented as his spending package, increases entitlements, money for housing, money for education, money for infrastructure, money for healthcare. And they do think that they would save some money on drug price reform. So I think everybody can see those things in the press and read about them to the nth degree. But what JP Morgan has done, which is really interesting, is they have taken a look at each of these line items and said, okay, when you increase this or decrease that, historically, this is what multiplier effect that spending has had on economic growth. And so when you look at this bottom chart, if you look at the projected outcome on the economy, this is suggesting that, okay, well, corporate tax cut, homebuyer credits, the things at the top, would be multiplied on the economy to a certain degree. And some of the spending areas, for example, federal government purchase of goods and services, that money spent there tends to have a 2.5 times multiplier than some of the other things that the government could spend money on. So it has like this acceleration effect on the economy when you spend things on certain areas, and each different area has a different multiplier effect. So when JP Morgan finished their conclusion on this very thorough white paper, their conclusion was that the Biden plan, if implemented, would actually increase economic growth, most likely because of these multipliers on the spending, but it would probably hurt stock price values, at least initially, because the earnings of companies would be less because they would be paying 8% more in taxes. And so you might have a situation where the economic growth is rising, but stock values come down, and then at some point they all rise back together. That's sort of their theory on these agenda items. So, and this is sort of the summary of what they put through. They said, hey, if you take the tax cuts and the Trump cuts, this is how much more money that the Biden proposal would bring in revenue for the government to pay down debt, to run, to operate, versus Trump's continued tax cuts would continue to run a deficit for the federal government at current spending. This is a chart that I found it to be pretty interesting, but these are some of the very specific things that Biden is looking to tax and at what rate. I put this slide in here more so that folks watching the video could pause it later and look at each line item and kind of think about, hey, do any of these things affect me individually? I'm not going to take you through all of them, is pretty self-explanatory. But there are a lot of little items that for many of our individual clients, some of the things in here may help, or may hurt. It kind of depends on where you are. But I put the chart in here so you could see that. And also on his spending side, this is where he would like to spend additional capital on these different specific things. And so if you work in one of these areas, you could kind of extrapolate that if there's going to be more government spending there, maybe there's going to be more wages, more opportunity for earnings. Who knows? But I didn't put these charts here to kind of go into the detail more, because I just don't think a lot of people see this stuff. All the things we've seen on TV and all the things you hear talking about the differences in the candidates, they don't tend to highlight some of these very specific things. Okay, Justin, you want to add anything before we kind of move on past where we're at with kind of the concept that taxes are going to would go up if Biden gets elected, but spending would go up, and what we just discussed there?
No, I think like you said, it's just the data. I love the data in the charts, because all you see on television or almost anywhere else is how one's horrible, one's great. You're not going to be safe here. It's all going to go to heck in a handbasket here. So being able to look at some of this and see what the broad policy is, and then being able to apply that to your personal situation and to our nation's situation that we find ourselves is powerful. We hope to be the voice of reason and facts instead of just propaganda.
Yeah, well, hey, that's a great segue for another very hot topic, and certainly definitely worthy of the stress. But we've kind of come to the conclusion that the impact of COVID on the economy is probably the greatest single factor to determine what direction the economy is traveling in. And there's a lot of difficult things about COVID in terms of charting and forecasting, because we're learning new things every day. But I did want to kind of put this data up, and again, the validity of the data is up to the different data collectors and even the CDC and the government. So who knows what methodology that they use, but JP Morgan felt that this was a pretty good representation of what we see. And the chart on the left is really showing us that, initially we had a lot of spiked up. We didn't know what to do about it. There was a lot of deaths per number of infections. The orange is the deaths per number of infections. Obviously, how many people are infected, we don't know. But there seems to be, in the last couple of months, a downward trending path for the number of infections and the number of deaths in the U.S. The chart on the left is the U.S. Still a long way to go. Certainly by no means out of the woods. But I found it to be strikingly curious that when you look at the same data outside the U.S., that it's quite a bit of a different story, in that the infection cases continue to rise, and the reported deaths continue to, as a percentage of cases, continues to get smaller and smaller. I don't know why. It appears that outside the U.S., there's more progress being made to fight it than there is in the U.S. I mean, I have my suspicions, as we all do, but the data is really compelling that that we're improving on both non-U.S. and U.S., but to very different degrees of improvement. And then this slide, wake up, computer. I thought this one, you can't mess up the data. And so I put this in here, but we kind of know based on census, I mean, how many people were born, 65 years ago and 67 years ago and 70 years ago. We kind of know what the projected amount of deaths per year is supposed to be, or per week is supposed to be, if you take the 52-week yearly number and divide it, by week. And this, this is pretty factual. Either you're still living or you're not. So it's difficult to mess this data set up. But in the US, we can see that the excess deaths, which we would presume are COVID related by and large, really spiked up March, April, and then they went down. And of course, they went up again in July. But the last readings in August for this data set were really getting close to the normal long-term fatality rate. So, you know, we don't know the classification of somebody died with COVID or from COVID. Like, that's a big question mark. And then, you know, if things being classified COVID that were formerly classified something different. But what we can see is, if you look at the trend recently between social distancing and people wearing masks and really being, you know, almost feeling like patriotic, if you will, to protect your neighbor and put on a mask in case you have it, you don't want to give it to them. I think that this is heading in the right direction. And this gives me optimism that maybe the stock market and the economy are positioned to improve more broadly, not just the top 5 or 6 names, because really people are scared. I mean, people are scared to go out and do business and live life and experience being entertained and going out to dinner and taking vacations. And as this, one way or the other, gets back to a more normal number of fatalities, I think that just helps to resolve a little bit of the problems. I know that's a hot topic, but I felt like this chart, you can't mess it up. I mean, this is how many people were projected to pass away each week this year, and this is how many did. And I think it's at least trending back towards what would be considered normal. Just want to touch on this concentration one more time in the tech stocks. So on the left-hand side, you know, basically the top 20 companies in the S&P 500 now make up almost 45% of that 500 company index, and their value in the top 5 are certainly over 25%. That concentration risk is something that I'm really concerned about, because I was an advisor in the late 90s and I saw concentration risk really crush people in 2000, 2001, when the tech stocks ran up and everything else was going down. The chart on the right overlays what happened in the market back in the late 90s. Those, you know, mega cap companies just ran up, and then of course things got really bad, and you can kind of see we have a similar run up. Now, I'm not suggesting that we're going to have this terribly nasty 3 or 4 years to follow. What I am suggesting is that the rest of the market has to catch up, because it's way ahead of itself. And whether it catches up because the COVID risks are managed, maybe the China situation is managed, maybe people become less fearful to spend money because of politics, and I don't know, but either the rest of the world has to catch up or the top have to come down, because we're not going to see this divergence for the long run. This is very interesting right here. Okay, newsflash: something comes out on the news. When the information coming out on the wire is about the Federal Reserve or about inflation or about interest rates, when those are the topics, the concentration of those 5 goes higher. Money flows into those mega cap brands. When news comes out about the election or election uncertainty or changes, about a vaccine, or about stimulus, we see a rotation of the money holistically from those mega cap companies to the broader market. So I don't have an actionable item to present here, but I think what this tells us is that the market and the dollars in the market are ready to move. Investors in the herd mentality are prepared to make major shifts quickly based on new information. And the things on the left tend to be correlated to more government support, more, propping up of the economy. The things on the right maybe suggest maybe once the election is passed, we'll get some more order. Maybe the vaccine will bring more order. I mean, it's just interesting how some of these news topics are moving the markets. And as Justin said, the way we manage money, we don't really try to pick the winning horse in the race. We try to be diversified and have a lot of different things, and then we just have limits that we won't allow things to go under before we make changes. So I just thought that was an interesting tidbit. I will mention on the political front before we move on to looking forward is that the China trade stuff is an absolute mess. The trade deal, phase one, China was committed to doing, a certain amount of purchases of U.S. Goods and services. And for 2020 calendar year in agriculture, we were supposed to see $33 billion of spending. They did 8 so far, 83 manufacturing. They've done 28 energy, 26 they've done 4. China's not doing what they said they were going to do. Now, I don't know what the terms of the deal were that maybe make them want to do it or not do it, but it's still a mess. And once the election's over with, no matter who is elected, they're going to have to come back and deal with this. Even if COVID gets resolved, this is still going to be a problem, and I think we have to keep our eye on it. So what do we do with all this info? A couple more slides, and we'll wrap it up. So this is a piece that we actually borrowed from one of the fund companies that we've done some things with over the years, just showing you, if you go back in time since 1933, there's no real consistent pattern about the direction of the market based on who is in leadership between the Republicans and the Democrats. I feel like every time we have one of these elections, we feel like, well, if we just get somebody else, it'll be better. And then we get somebody else and it ain't any better. So it's pretty evenly balanced historically. $1,000 invested in a growth fund in 1930 would be worth 10 million today. And you can see along the journey, different points in time where that would have been at higher numbers. And both political parties were in the lead chair and the lead spots in Congress along that journey. So I don't think that there is a rational way to lead to, if this party is in power, this is what the market's going to do. I don't think that's supported. However, there is an interesting cycle where money being put to work in the stock market, if you look at the presidential cycles every 4 years, you see a pattern where in the first 2 years and even in the third year of a presidential office being held, there has been historically a lot more flows into equity funds and less flows into money market funds. And in the third year and in the election year, there tends to historically be a pattern where there's less money being invested in the equity markets and a lot more money moving to the sidelines because of the uncertainty, right? So if you understand that there's this pattern and it's a really strong reoccurring pattern, you might draw the conclusion that if we're in year 4 and now we know next year the cycle starts again, that historically there's been a lot more flows to equities the next year, it might make the case that if you're a long-term investor, maybe you should not wait until the prices go up before you decide to put that extra cash to work. It's a very interesting sort of historical set of facts. This is charting it sort of by returns, all right? So essentially how many years that the market has had the volatility. In the non-election years, the volatility's been there, but the net result of the market tends to have been higher. And in the election years, the volatility is still higher and even greater, but the net results have been lower. They both trend in the same direction. But if you would have only invested in the election years, you would have produced a lot less fruit than if you would have only invested in non-election years. But when you're buying today for tomorrow, you want to buy low. You ultimately want to sell when it's high, not when it's low. So this kind of brings us to the conclusion that this might be a good time to be invested before the election results, before the uncertainty settles, if you've got long-term money that you're trying to make grow over the next 10 years or so. This is an example of somebody who said, I'm just going to put $10,000 a year, every year into, I think, an S&P blend position, and just not paying any attention to the election cycle or uncertainty. You know, over 22 election cycles, 10,000 would have grown to 15,000. If you had an investor say, well, I'm going to take my 10,000, divide it into monthly contributions of $1,000 a month, and do it for the 10 months of the year, first 10 months of the year, every election year, actually would have made a little bit more, excuse me, a little bit less, but you would have had less cycles that were bad, right? Like it would produce zero really worst case cycles. And then the investor says, I'm going to wait till it's all settled and cleared up, and then I'll put my money to work. The next year, that 10,000 would have only averaged growing to 14,000 over that period of time versus a higher number. So, you know, you can find data to support anything you want out there these days, but I do think that there's a lot of money sitting on the sidelines today, and the uncertainty is preventing investors from taking positions that they know they need to take for the long run, especially in the face of inflation. I know whoever gets elected is going to have to inflate the economy to get out of this debt. And so you got to own things that benefit from inflation, and stocks do until the inflation rate is up over 5 or 6%. That's been documented, and I can't really use the word proven, but it's certainly a thesis that carries a lot of weight in the investment community, that inflation under 5% is good for stocks. Justin, you want to add anything?
Yeah, touching on this topic. I mean, you know, we've done this long enough. Personally, I've had clients when Obama was elected call shortly thereafter and say, sell everything. This is the worst thing ever. Sell everything. I'm going to cash. We had the exact same, not folks, but the exact same emotion after Trump was elected. Sell everything. This is awful. None of those folks were right. It didn't. And so I think that the power of the U.S. economy and innovation and technology and our people are stronger than many of these things, which are important. Okay. But when you make that decision of get me out, and this is true of almost any time, but especially around emotion, okay, when it's driven by emotion because you're upset that maybe your candidate didn't win, and we've saw it on both sides. It's not the first decision that's the tough one. It's the second decision. Okay. So you can say, get me out. Knee-jerk reaction. If you don't have a plan on how, when to get me back in, it doesn't work out well, because
you stay out forever.
There's only 3 outcomes, right? From when you get out, it could go up, down, or flat. If it's flat, you're just kind of If it's down, you're say, I told you so, right? And you're never going to get back in at a point worse than when you got out, because you're still riding high that I told you so. Or if it goes up, you're going to dig your feet in and say, just wait, it'll happen. But 5, 10, 15 years can go by. It didn't happen, and you're stuck. You're left behind. So before it ever happens this time, I would encourage folks to maybe try to keep the emotions out of it as it relates to building wealth, and instead focus on price action and trend and some of the things we look at that is mathematical, non-emotional, and nonpartisan.
Yeah, those are great points, Justin. Hey, if you have questions, we're going to try to take a couple. I don't want to take too long. But before we jump into our conclusions for the call, one of the questions is, what's the biggest tangible impact to the extreme levels of debt to, just normal people, right? And that's a great question. And there's a lot of different theories on that. I believe that what is likely to happen is a couple of things. One is, when the economy is booming, everybody has a little bit more money to spend. Things are just a little bit easier. People can find a job that want one. Part of the economy is the government's spending. It's part of it, And so if the debt becomes so much that it is taking a larger and larger chunk of the government's tax base and requiring it to just pay interest, that's money that's not able to go into economic growth. So one issue is the economy has a bigger and bigger headwind to actually go forward, the more interest that we're having to pay on debt. And it would be that way in a household as well. You know, the harder and harder you work, if you owe a lot of money and the interest just gets higher and higher, you never really feel like you're getting ahead. So one of the things is the economy will have long-term headwinds that could be so substantial that consumers would feel it and see it. So that's one thing. I think the other is that if we monetize the debt, in other words, we print money, we pay the debt with printed digital money, and we just create more and more and more money, and it gets implemented in the economy, for those people that don't own assets, that the value of those assets can go up with that inflation that's caused by having more dollars in the economy, you will have less dollars to pay for goods and services that will cost more and more and more, because the inflation will come when the more and more dollars are printed to pay the debt into the future. So I actually think that creates a greater divide between the wealthy and the poor. I think that's one of the outcomes, is that, you know, the poorer segments or the less wealthy people in our economy, they don't have money invested in things that can go up in value and benefit from inflation. So to them, life just gets harder and harder and harder. So I think you have rising interest rates as a challenge. I think you have quality of life and GDP growth is more difficult over time with higher levels of debt. And I think the division of wealth becomes more and more extreme. And, you know, I mean, history books tell us when it gets to a certain level of extreme, you get different kinds of problems, not just economic problems. So I think that's a big deal that we deal with it at some point. I don't think any of us and our clients that we serve, that our lives are going to be radically changed in the next 10 or 15 years over the debt. I think if we don't deal with it, what's going to happen is that our children and grandchildren are going to live in a very different world without the opportunities that we've had. And I don't think that a politician can solve the problem. I think we as a culture have to decide that we're okay with, you know, paying back some of what was spent. And in order to do that, we have to set down our frustrations on how it got spent, because a lot of times it was spent on things that none of us would have personally chose to have spent it on. But I think that's how it impacts us in the future, managing your assets to try to benefit from rising inflation is a key. Okay, let's see if there's any other questions. Social Security, Medicare, general effects. Interestingly, I haven't seen anybody propose any Social Security changes at this point, other than more spending on the Medicare and sort of medical services side. That's yet to be determined. Okay, so I will circle back on that question. So just to conclude, and obviously we appreciate everybody connecting with us and getting a sense of where we're at on things. There's just always a reason to worry about the future. I think we could say prices are too high. There's too much concentration risk. The election could be a mess. We got more debt than we could possibly ever get out of. We could come up with all kinds of things to worry about. But as Justin said, if you stay out of this market for a long period of time, it's not how you build wealth. And the markets have been incredibly resilient over, multiple generations. I don't think we should count it out. We do have 32 million millennials marching straight towards peak earnings. And I think that is a big thing. And there's another 50 million that won't be far behind the leading edge. So, we've got a lot of people moving into a portion of their life where they're likely going to earn more and spend more. That will help us. We expect to see higher taxes. There's a lot of financial planning opportunities right now around the notion that your taxes may be higher in the future in certain situations. Now, that's not everybody. Little Lulu, who's retired, living off of her pension and a couple of little IRA withdrawals, her taxes probably aren't going to change. But if you own a business and your business is growing, you're probably going to be paying more taxes 3 years from now than you're paying today. If you're a high income earner, you're probably going to pay, a really high income earner, you're probably going to pay more taxes in the future. So there's some planning opportunities there. I don't know who's going to ever get elected and say, hey, let's go do something about this debt. But if nobody takes a stand on it, then inflation and climbing interest rates are probably going to be in the cards. And I think we need to plan for that and how we do our jobs. And then, Justin mentioned it earlier, but we do have a plan. We have a plan to deal with market volatility, no matter what the reason is. And I'm glad that we have it. And it's worked really well this year. Many of you got an email from myself or one of the guys in the office back in March saying, hey, the world seems like it's on fire and you're down X. Now we're in nothing like the rest of the world because we had a plan, and here we are today back to where we were near the beginning of the year. And, most of our clients didn't have to feel that very uncomfortable minus 35 or 36% that the market threw out there in February and March. So have a plan and stay the course and stay focused on how these things might impact your personal financial situation, and we'll get through it. So what I'm going to do is if anybody has any other questions, Justin's going to read through the final disclosures that we have to put out there. But if you have questions, if you want to type them in before I actually end the Zoom call, I'll make sure that we mark down any questions and who put them out there and get back to you. But thanks for the opportunity to serve you and your families. I wish that we could get with you live more. Crazy times, but we're going to keep on trying to make the best of it. For that, Justin, you want to read the final disclosures?
The views are those of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information. The S&P 500 index is an unmanaged index representing the largest 500 companies in the U.S. The Barclays Aggregate Index is an unmanaged index representing the overall broad bond market. Investors cannot invest directly in indices. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Past performance does not guarantee future results. All investing involves risk, including the loss of principal. There is no assurance that any one investment strategy will be successful. Thank you.
All right, everybody. Have a great day. Enjoy this beautiful fall afternoon.